Well, hello, everyone. Today we're thrilled to have Ed Yardeni of Yardeni Research. Ed, thanks for being on Sunpro TV.
Sure, my pleasure.
So you're very well known within the investment community here in the States, obviously. But for those who aren't as familiar, so you started Yardeni Research in 2007, I
That's
believe.
right. Yep.
You are an economist by training. You have a
hmm
PhD in economics. You started your career at the Fed as an economist. And you then transitioned to being an economist on Wall Street at
Right.
a number of then very famous major firms on Wall Street, places like E.F. Hutton, C.J. Lawrence, Deutsche Bank, Prudential. And you transitioned to being an investment strategist.
As well. Yeah, I'm doing both.
Right, right. So, how have those experiences, which are similar but quite different, I would imagine, being an economist at the Fed, being an economist at a Wall Street bank, then being an investment strategist, how have those experiences kind of shaped the investment framework that you have today?
Well, Fed Chair Bernanke wrote an autobiography of his time at the Fed, and he said that he had been trained as a academic economist, and when he went to the Fed, he had to learn sort of a different way to understand how the economy operates. And he called it current analysis, which I think is a good phrase for what I do. Basically, like the Fed, I'm very data dependent. I've learned over the years that unlike academics who very often start out with a theory and then look for data to support it, I operate the other way around on Wall Street, or you have to operate the other way around, and that is be unbiased, not have any preconception, certainly know all the theories and the models, but the important thing is to be driven by the data. And so, like the Fed, I'm very data driven, and I do have an outlook of how I think things will play out. And as the data becomes available, I try to give my accounts an understanding of the extent to which I think it supports my base case or not. And I do tend to have three scenarios more often than not. I don't like to just have my base case and say that's the way it's got to be. And my base case more often than not tends to be optimistic. I have a responsibility, I think, to think about and alert my accounts to what could go wrong with my optimistic story. What makes my job somewhat easier is that it's not that hard to think of things that can go wrong because there's a whole bunch of economists and Wall Street strategists that tend to be pessimistic almost all the time. And so I'm obviously keeping on top of what they're saying because they are influential. I also try to think of what are they missing, and more often than not, I can't think of anything any worse than the scenarios they come up with.
That's helpful. Can take us, please, then kind of inside your process. I know, research is often a very organic process, but at the same time, you must have and have developed over the years sort of the key principles or drivers that you kind of always start with. So for
Sure.
some, it might be demographics trends.
hmm
For others, I mean, you mentioned, optimism. So it could be that, over time markets go up, like whatever they may be for
Yeah.
you, what are some of those key sort of core principles and drivers?
Well, I think, again, it's a fairly diversified approach to forecasting. You have to do that because things change. What drives the consumer isn't necessarily always the same. But when I look at the consumer, like every other economist, I recognize that consumption is first and foremost driven by the purchasing power, by the incomes that consumers have. But I also do factor in demography. I'm a baby boomer, and having the insight of a baby boomer has been helpful. because the baby boomers have been such a big percentage of the U.S. economy, of the U.S. households. And so during the 70s and 80s, I can look at what was happening in my life and recognize that demand for housing was going to be very strong, that the demand for housing related retail sales would be very strong, that the demand for SUVs, as to drive the kids to the soccer game would be strong. So that was helpful insights. I also factored in more recently the demography of retirement. The baby boomers are retiring now, and collectively they have $80 trillion of net worth. That's trillion, not billion. So there's an enormous amount of net worth. A lot of them have paid off their mortgages. They have a lot of equity in their homes. They have stocks, they have bonds, they have pensions. And anyways, you put it all together, and it's one of the main reasons that over the past 4 or 5 years, when just about every economist was predicting a consumer-led recession, I argued that that would not necessarily be the case, that retiring baby boomers would continue to spend. And that's what's been happening. A lot of economists have been pointing out that low-wage workers are having a tough time and cutting back their consumption, particularly discretionary consumption. And I completely see that. It makes sense. But I've stressed that on balance, when you put all the various forces together, consumers will continue to spend. I've also been focusing on a theme of a digital revolution in the United States and the world. The digital revolution started in the mid-1960s with IBM mainframes. And the point of the digital revolution is to process as much data as we possibly can, as quickly as we can, and as cheaply as we can. And so we've come a long way from the IBM mainframes. We had mini computers, the digital equipment sold in the 80s. Then we had PCs and laptops, Microsoft Windows operating system, and Excel and Word. If you think about it, those Excel and Word were really the original applications. There were only two of them, but they were very useful, but they were useful for only certain kinds of businesses or activities. Now, with the introduction of the cloud in 2011, we process even more data now. We can store more data because of the cloud. And now we have AI. I view AI as just a super app that can be used for all sorts of businesses, all sorts of personal needs. And AI is run on chips that allow processing to be very, very quick, almost like a supercomputer. You can have a conversation with AI. It's evolutionary. The revolution is the digital revolution, and we aren't stopping with AI. Quantum computing is likely coming, and I view that as another source of strength for the economy. So in 2020, I said, looking at the decade ahead, and I do try to think ahead in decades. I was born in 1950, so 10 years at a time kind of makes sense to me. And so I started out this decade saying it could be the roaring 2020s with consumers being surprisingly resilient, and the same thing for capital spending, based on the fact that more than half of capital spending now is technology. And then while others have said a debt crisis is around the corner, I've said that's not necessarily true. And that meanwhile, all that deficits that the government is running is another source of stimulus. We're spending $1 trillion on a 12-month basis now on interest payments, but it's called net interest outlays. It's an outlay, and $1 trillion is going from the government to investors who can either invest more of it or spend it.
Right, right. Just expanding on that a bit, and that's very helpful. background. So, how did you arrive at the Roaring 2020s kind of view? Obviously, it combines your view about the continuation of the digital revolution,
Yeah,
but if you could go in a little
sure.
deeper as to
Well,
why this particular decade.
again, it had quite a bit to do with my sense of the outlook for demography. I knew that the baby boomers were going to be retiring, so that would reduce the growth rate of the labor force because there's so many of them. It looks as though a lot of the baby boomers work beyond 65. 65 is often viewed as a retirement age, but a lot of baby boomers have been working into their late 60s and 70s. But then, of course, at the beginning of the decade, the pandemic hit, and a lot of people had some time during the lockdowns to think about the meaning of life and how much longer they wanted to work and whether they wanted to retire earlier and do some traveling. So that was another kind of factor there. But at the same time, the outlook was that the labor force would, instead of growing 1 to 2, 2.5%. I mean, when the baby boomers first entered the labor market in the 70s, the labor force grew by 2.5%, and real GDP got a good boost from that. Now I figured that the labor force would grow maybe 0.5% per year or 1%. And I thought that this would create a problem for businesses, a shortage of labor, a shortage of labor with the right skills, and that that businesses would solve this problem by using technologies that became quite apparent in 2020. I said AI could be one of the technologies. I didn't expect that by November 2022 that it would be introduced as ChatGPT and become maybe one of the more important technologies for increasing productivity. But we have had robotics, we've had automation, we've had managements focusing on ways to increase productivity, providing maybe more training for their people to increase their productivity. So I figured that we were going to have a productivity-led decade for economic growth, and it seems to be playing out exactly that way. And productivity is like fairy dust. It makes everything better. You get better growth, you get lower inflation, you get wages rising faster than prices, you get real wage increases, and you also get better profits. That was sort of the thinking on the Roaring 2020s. Of course, there are similarities and differences between the Roaring 2020s and the Roaring 1920s. Before the 1920s, there was a world war that killed millions of people. There was a Spanish flu in 1918 and 1919 that also killed millions of people. There was a depression in 1920 in the United States as soldiers came back and we had to change our manufacturing from a war-based economy to a more consumer-led economy. There was a depression in 1920. So, if you're an economist in 1920 predicting what the rest of the decade would look like, it was very unlikely that you're going to say it's going to be the Roaring 1920s. You probably were pretty depressed and thought that the outlook was pretty miserable. And we had a similar situation in 2020. The pandemic occurred, and we had the lockdowns causing a recession. And at the time, it was pretty hard to imagine that things were going to turn into the Roaring 2020s. But I did recall that that's exactly the way it seemed at the beginning of the 1920s, and it ended very, very strongly. Now, people remind me, of course, that the 1920s ended badly with the great crash, and then the depression during the 1930s. And I think the economy's already demonstrated its resilience with regards to shocks. What shocked the economy in the late 1920s and what caused the initial crash in the stock market, I think, was the realization that Congress was going to pass a tariff called the Smoot-Hawley tariff, which was passed in May of 1930. And so I think the tariff back then is what caused the Great Depression. The stock market did decline sharply in late 1929, but then it rebounded by 50% and was back to where it was. By May of 1930, the stock market was back to where it was in April of 1929. So that was no big deal. But then they passed the Smoot-Hawley tariff. Commodity prices collapsed. Farmers couldn't pay their mortgages and for the loans they had. Same thing for businesses that did global business, and that's what caused the Great Depression. Well, we just had a bunch of tariffs imposed by the Trump administration, and so far, both the U.S. and the global economies have done surprisingly well. We had the pandemic, we had the lockdowns, we had the social distancing that people couldn't buy services, but they could buy goods. So we had a boom in goods consumption that led to a supply chain disruption, led to inflation, led the Fed to raise interest rates. Then Trump came in with tariffs. And now we've got the challenge of what's going on in the labor market with a shortage of workers. And yet, real GDP is at an all-time record high. And yet, the last recession we really had was in 2008, 2009. The recession we had in 2020 was only 2 months, and it was a lockdown. It was artificial.
Got it. You recently made headlines for downgrading the Max 7, and you prefer the impressive 493. You also went market weight technology.
Technology and communications, the two of the 11 sectors, yes.
Right, right. Based on what you just discussed, the coming labor shortage and the need for productivity gains, those that are still bullish on tech now would argue that during periods of labor shortage, historically, tech has tended to outperform. They would argue that the labor shortage issue and therefore the need for further productivity gains,
Sure.
is still going to continue for a while.
Yes.
Therefore, they would argue that tech will likely continue to outperform. You don't have that view. So
No.
how do you square, and I know you're coming from, that they have outperformed and they're now a very big part of the
Exactly.
overall market. But how do you square the two, that if the labor shortage continues and the need for productivity gains continue, then that drives tech's outperformance further?
Well, I think in some ways I'm declaring mission accomplished. Technology, communication services, they've already created a lot of the hardware and software tools that companies have been buying and are using to increase their productivity. And so I'm arguing that the productivity response is already visible for the S&P 493. I mean, the Magnificent Seven aren't going to stay magnificent if all they're doing is business with one another and they're not selling their hardware and services to the rest of the businesses, the rest of consumers out there. Now, obviously, they've been doing that. But now what's changed is the Magnificent Seven, which kind of used to be their own kingdoms. They had their own strengths. They had their own moats. They didn't really interfere with each other. But ever since the introduction of AI, and the public introduction, again, was November 2022 with ChatGPT. But ever since then, the Magnificent Seven have started to compete more with one another. For a while there, it looked like NVIDIA was the only company that had the chips for training large language models used in artificial intelligence. And then along the way, Google suddenly said that they have chips that they're using internally. Amazon has chips that are being used for those purposes. The AI is challenging the whole advertising model. that has been very successful for Facebook. So Facebook is being forced to compete. What really has changed is, of course, they're all spending a tremendous amount of money on capital investment, where they really don't know whether they're going to get a return on that investment. But what we do know is that as a result of competition, their margins are probably going to shrink. They may not get as much of a return on investments as they expect, and that'll all be to the benefit of the consumers, the users of their technological services and hardware. So I think some people are looking at history and saying it takes a long time before new technologies really have a positive impact on productivity. I think AI is somewhat different because, as I said, back in the late 90s, we only had two apps, and that was Word and Excel. And once you took all of your secretaries on, typewriters and electric typewriters and replaced them with Word, once you replaced a lot of bookkeepers with Excel, that was it. And it didn't apply to every business model. It seems to me that every business is looking into how AI can be used to increase their productivity. We're getting calls from the people who buy our research that are asking us, how can we integrate what we do with their process to make it more efficient for them to receive our research, to get to what they want to find that's important to them. And so we're seeing a lot of that. I use AI all day. Sometimes I use ChatGPT. Copilot is the same thing, basically, sold by Microsoft. I use Gemini 3, occasionally Grok. I try to see which one I feel more comfortable with, and maybe there's some that are better than others. But I use it all the time. But instead of going to Google search for each individual article now, AI organizes the information that's out there, gives me a summary, and then I can read the individual articles as I like, and come to my own conclusions. Clearly, AI still has to be checked. It does make mistakes, but on the other hand, it does provide the original sources on the internet, and you can check whether those sources are legitimate, or some of them might be have been created by another AI agent, I suppose. But I'm using it all the time, and we're looking at ways to use AI to increasingly automate our production instead of, and sometimes we're finding that a task that would only take 10 minutes a day, now we can do in 30 seconds. And that adds up. And if you can do it for a bunch of 10-minute tasks, it frees up a lot of time during the day for thinking and double checking AI.
Got it. So in terms of the application of AI, which is why you're more positive on the impressive 493 as opposed to the Max 7, are there sectors within the 493 that you think are going to be bigger beneficiaries than others?
Well, until a couple of weeks ago, we were recommending overweighting information technology and communication services. The problem we got is they are now 45% of the market cap of the S&P 500. And so I said, well, wait a second. If I'm telling people to overweight something as two sectors that already have a weight much bigger than their importance in the economy, then maybe it's time to cut back and just say, well, market weight them. 45% is still a lot, but I think it still covers the notion that this all requires technology to provide the goods and the services and to continue to sell those things. So now a market weight there, but I have been also recommending overweighting financials and industrials, and I would stick with that and maybe add to that, because financials are also in many ways a technology. There's something called fintech. A lot of financial companies are spending a lot of money on technology, including AI, but blockchain and so on. I mean, I still have a checking account. I still write checks, and I both for my personal needs and for my business. And I don't know why it's not all Venmo by now, but it will be stable coins very, very shortly. So I think financials make a lot of sense, particularly the laggards, the small, mid-sized banks, financial institutions. They've lagged behind, but I think you'll see a lot of mergers and acquisitions. Industrials is the same story. The industrials have done extremely well. I think mid-cap industrials look very good to me still. I think they could perform well. We continue to have spending on data centers, so that's good for the industrials. Caterpillar's been one of the large caps stocks that has performed especially well. GE has done well because of providing the picks and shovels for the AI business. But we've also seen that there's been a lot of onshoring. Uh, I don't know how much money the President Trump has actually raised, but he claims that it's something like $15 trillion in his tariff negotiations. He used that as a stick to get foreign companies and foreign governments to commit to spending in the United States, but it's going to be trillions of dollars. So that'll be providing some demand for industrial equipment. And then I have been underweighting healthcare, but now I would overweight healthcare, particularly biotech, thinking that that sector is seeing a lot of mergers and acquisitions. Uh, Companies, the big pharmaceuticals, are looking to fill their pipelines with more product. So that looks like it makes sense to me. So basically, the other sectors I still would underweight, but I mean, it's hard to underweight energy and materials because they're like 3 to 5% of the S&P 500. So I don't really have a problem with overweighting them. So consumer staples would be underweight. Utilities have had a great run as an AI play, producing more electricity. I would underweight them because I think they've already discounted more than is going to really happen. I do in the materials area. I like the metals. I have been bullish on gold since 2024 when it rose above $2,000 an ounce. I recommended it, and when it got to 3,000, I predicted it would get to 4,000. So we're there above that, and then I think we'll get to 5,000 next year. But silver's done even better. Platinum has done even better. And so I would stick with the metals, including copper. So that's kind of what my thinking is.
Got it. The impressive 493 is still large cap, though
Yes,
they're
S&P
smaller than
500. Yeah,
right, though they're smaller than the Max 7.
yeah,
Do you see the broadening out to benefit small and mid caps too, or
yeah.
are there structural differences between the large and the SMID universe that necessarily doesn't make the
Well,
latter outperform?
the SMID caps have had a nice rally this year as the Fed has been lowering interest rates. My structural issue with the small and mid cap stocks is that the earnings of those indexes have been basically flat since 2022. Whereas the S&P 500's earnings have been a rocket ship. They've been extremely strong, going to new record highs. Now, recently, we have seen some improvement in the earnings of the mid caps, but nothing really as impressive as the S&P 500. And I think the structural problem may be that the large cap companies have a lot of cash. They are looking out for companies, small companies, where they can take their products and leverage them up into bigger products, into into bigger markets, into bigger revenues. And so it's frustrating for a manager of a mid cap portfolio because maybe they have a universe of 1,000 stocks that they look at and come and of those thousands they come up by maybe with 20 that they think are going to be great performers. They know they're not all going to be great performers, but if they could get one or two to be the next Microsoft or Nvidia or whatever, then they'll be very happy. The problem is there are large companies that are looking at the very same companies as a mid cap portfolio manager might have, and they're buying them, and that's great for a 1 day trade. You might be up 30% on that position, but you're never. But now you got to pick another stock to replace it, and so it's. I think that's the problem with the mid caps is that they're already targets for M&A activity that pulls them away before. So that leaves you with the stocks that aren't the profit prospects aren't all that great, which is why the mid caps have been kind of in a coma, earnings wise.
You mentioned biotech being a beneficiary of the technology that is being developed today, or sort of the broader AI technology, which would be part of your kind of brain acronym that you've been using: biotechnology, robotics, AI, and nanotechnology. Um, Nanotechnology in particular, how does one play that? What is that about, and how does one invest in that?
Yeah, I honestly don't know. I don't think it's big enough. There may be an ETF in it. I mean, we used to say Google it. Now what do you say? You say Gemini it or ChatGPT it. I think you just have to go and see if there's an ETF like that. The problem with all of these new things is they can be quite volatile. I mean, we did point out that quantum computing was going to probably be an important technology. Back in 2020, when we talked about roaring 2020s, we said quantum computers are coming, but we thought it would be 5 to 10 years away. And a lot of people thought it'd be even longer than that. But now 5 to 10 years looks realistic. And there are ETFs that invest in quantum computing companies. The problem is they're small. And meanwhile, the big companies like IBM, for example, and even Google are working on quantum computers. So again, you could have the right concept, which is to invest in quantum computing, and get into an ETF where you've got too many of these startups that wind up either being bought or just get crushed by one of the bigger companies announcing that they've solved they've got the solution for how to create quantum computers and make it commercially successful.
Got it. And coming back to biotech, I mean, part of an issue with investing in biotech as a group is one, it's pretty obvious that they will be a beneficiary of AI and the latest technologies, but at the same time, there's just so many idiosyncratic factors
Yeah.
in these companies. So,
Well,
is your
yeah. The only way to invest in that area is with an ETF.
right?
And there's some ETFs that have been around for a long time. They're very liquid, and they weren't doing much for a while, but this year has been a very strong year for those ETFs and should continue.
Got it. Part of your recent call is also to go, you famously preferred that investors stay home as opposed to going global, but
Yeah.
you have a change in view about that. So ex-US, though, is a very large place. Is there some places that you favor over others, maybe
Mhm.
developed ex-US over EM or vice versa?
Well, we've been recommending stay home, which means overweighting the U.S. in a global portfolio, whether it's an American or overseas portfolio. We've been recommending that, and So, we kind of had the same realization about global investing as I had about technology investing in the U.S. I mean, as I said, communication services and technology now account for 45% of the S&P 500, telling people to overweight them. What does that mean? Does it mean, do I really want them to have 55, 65%, 75, 70%? I mean, at some point, you have to have some consideration for diversification and risk. Same thing happened to me with looking at the global portfolios. It worked very well. 65% of the market capitalization of the MSCI All Country World Index, so all stock markets take all their market capitalization, and the United States accounts for 65% of all of that. I mean, the United States is exceptional. We've got a lot of entrepreneurs here. We've got a lot of technology. We've got a lot of growth stocks. But 65%, I don't really think you should have 70 or 80% of your portfolio in the United States after it's had this kind of run. So I think it's time to, from going overweight, maybe just market weighted. It's hard to find a lot to offset that on a global basis. Japan and Europe have already had some good runs, but I think emerging markets would make sense. And I'm recommending right now. I mean, just one idea is emerging markets. EMXC is emerging markets ex China. I'm not comfortable investing in China. The government still calls the shots there, and it's not really an entrepreneurial economy. It's not a competitive economy. It is very, very much a managed economy. So I'd much rather not invest there. And I think there's still, I think the ex-China emerging market ETF is a good way to invest globally in emerging markets. I think the important thing to realize about emerging markets is they have large populations that are aspirational, that they have middle classes that want to be more prosperous. So there's, a lot of demand for consumer durables. And as consumer durable demand sort of matures, because people, as they prosper more, they don't need or buy as much durables, they buy more services. So things like financials have done very well in a lot of emerging markets. A lot of emerging markets don't have very good financial systems, but now they're using stablecoin, and they have some financial institutions that dominate others. China, if you want to invest in China, it's interesting to note that so far this year, the best performing sector in China hasn't been technology, it's been healthcare, which again makes sense. You've got a rapidly aging population, so why not look at healthcare? China, I just view it as a really good trading vehicle. It really hasn't gone anywhere for years other than with a lot of volatility. So sure, you can make 20, 30%, and then you wind up giving it back pretty quickly. And China's economy is still being weighed down by China's economy is still being weighed down by the property bubble that burst. There's home prices are still falling there. There's still a huge negative wealth effect. And the Chinese investors have gotten whipsawed in the stock market. So I don't think if they're making some money in the stock market, that's going to give them a lot of confidence that their wealth is back. I think they've turned into major buyers of gold because it has been amazingly stable and without a lot of volatility. Maybe they're even going into silver. I know people in India have long been investing in gold. So when you buy an emerging market ex-China, you get a large chunk of India, Brazil, Mexico, and Indonesia. And that covers you for commodities, and it covers you for the demography of prosperity.
Got it. You mentioned stable coins, and earlier you talked briefly about fintech. What is your kind of general view on the tokenization of assets? Wall Street there's a view that Wall Street is going to innovate on the blockchain. You are not so optimistic on Bitcoin itself,
Right.
but what's your kind of general view on cryptocurrencies
Yeah.
as an asset class? So
Yeah.
tokenization of assets and cryptocurrencies.
Well, the potential problem with blockchain and you get your own code that if you forget the code, then suddenly you don't have the code you need to get your $20 million out of your account. I mean, at least when you have an account with a financial institution, every month you get a statement, and you can always take that paper and say, "Here, this is you're showing me zero. How did that happen?" If suddenly we get quantum computing breaking codes and you had $1 million in a Bitcoin account, and then you go try to open it up and it's not there anymore, who do you go to? Do you go to the local police? Do you go to the country's FBI or CIA? What do you do? I mean, there's not much not much you can do. So my problem with Bitcoin, even my real problem with Bitcoin, other than that issue, which is an important one, is I have no way as an economist to value it. So I'm not for it or against it. If you think it can go to a million, I say, yeah, yes. But I think in the United States in July, Congress signed and passed and the president signed the Genius Act, and the Genius Act basically legitimized stablecoins, and stablecoins are exactly that. They're stablecoins, so they're like bitcoins, but their price doesn't change. It's pegged to a dollar. A dollar is a dollar, and it's backed up by a dollar's worth of treasury bills or very similar liquid assets. And so Bitcoin, one of the functions of Bitcoin was supposed to be a means of exchange, a currency. But now you don't need Bitcoin. The stable coin will do that very well, much better, because you don't have the uncertainty that, if you're a merchant and you're forced to take payments in Bitcoin, you're taking a big gamble that by the time you get to convert it, it's moved. Maybe it's gone up, but maybe it's gone down, and that's not the business you want to be in. So you do it with stablecoin, and stablecoin's been around for a while. It's already used quite a bit in emerging economies, as I said, with where the financial systems aren't as developed. So I think stablecoins takes the transactions function out of Bitcoin. And again, this was passed in July, and July was pretty close to the record high in Bitcoin, and now it's come down a great deal. So I think it's already kind of been repriced for the fact that it's not going to have a demand as a transaction currency. So that leaves you as a store of value, and so far it's been a very volatile store of value. Gold is, people say Bitcoin is digital gold. I say gold is physical gold, is physical Bitcoin. So that's kind of where I'm looking at. I'd rather own gold than Bitcoin. Gold I can't value either, except I have a very, very simple model. If you take the S&P 500 and put it on the same chart with the price of gold, same scale, what you see is that they're inversely correlated in the short run. So gold is a great way to diversify a portfolio that you have the S&P 500 in. However, the longer term trend is almost the same. And so I have the S&P 500 getting to 10,000 by the end of the decade. And I think gold could get to 10,000 by the end of the decade as well.
You have said that 2026 could be the year of the bond vigilantes. Bond vigilantes, for those who are not familiar, is a term that you came up with. So, first of all, what is a bond vigilante for those who don't
Yeah.
know? And what is the implication, and
Yeah,
how does this permeate through the markets,
yeah.
ultimately through the equity markets in 2026, when the Fed is lowering
Mhm.
short-term rates, but the bond vigilantes are
Raising rates.
raising
Yeah.
rates.
Well, let me put your question in a slightly bigger context, and that is, I'm very often asked what could go wrong with the roaring 2020s. And my experience over the past 45 years has been more often than not, when something goes wrong for the stock market, it's because something goes wrong for the economy. Something causes a recession. And what I've observed is that very often the tightening of monetary policy leads to a financial crisis. And the financial crisis then very quickly becomes an economy-wide credit crunch where even good borrowers can't borrow. And so it's the credit crunches caused by tight monetary policy that in the past caused recessions, caused bear markets. This time, because of my roaring 2020 scenario, I said, I don't think that's going to happen. I don't think that tight monetary policy and monetary policy went from a 0% Fed funds rate in 2022 to 5.5% in 2023. And I stuck to my guns. And by the way, Jerome Powell also thought that there's a way forward without a recession. So usually, historically, what happens is something goes wrong in the credit markets. So if you ask the question, what could go wrong in the stock market, what could go wrong for the economy, it's the first thing you want to do is think about the credit markets. And so I think a lot about private credit. Everybody's concerned that there are cracks in that marketplace. And the problem with credit is even the credit people don't know what they're doing. They create these kind of derivatives and things that they don't know how they interact in a crisis. And suddenly you realize that, oh, we didn't know about that, but now it's coming to bite us. I don't think private credit's going to bite us. I think if something blows up in the private credit market, it reduces the rate of return on a portfolio. It doesn't deplete the capital of a financial institution that forces them to cut back lending, which causes credit crunches. So that's my quick idea there. Now, another thing that could go wrong in the credit markets is the bond vigilantes. I coined that term back in 1983. And when we just had this inflation in the 70s, and investors were very worried about inflation coming back, and they worry that the Fed and the Treasury might not maintain law and order in the credit markets. And so I said, well, if that's the case, then the bond vigilantes will take the law into their own hands. That's what vigilantes do, and they'll establish their own control over the financial system. So if the Fed and the Treasury don't keep inflation down and they have excessive policies that bring inflation up, the bond yield will go up, and that will slow the economy down. And that worked pretty well in the 1980s, and then inflation came down a lot. In the early 90s, Bill Clinton was told by his advisors about the bond vigilantes and that they had to maintain fiscal discipline. He listened to them, and we actually got a surplus in our budget and government budget in 2000. In 2000, we actually had a budget surplus, and Fed Chair Greenspan went to Congress and gave a talk on what we should do about the surpluses. And once we paid off all the debt, what do we do with all that surplus? And then, of course, 9/11 hit. And so created a deficit issue all over again. So where are we now? Well, the bond vigilantes right now are in Japan. We've seen the Japanese, the Bank of Japan just raised short-term interest rates. So they're trying to slow inflation down. They're trying to normalize the level of interest rates. And at the same time, the new government is kind of slamming on the accelerator. So you got a car where the central bank is stepping on the brakes and the government stepping on the accelerator. It's not a good way to operate a car. And the bond vigilantes are saying this is not good, and they're pushing bond yields up dramatically in Japan. They're doing the same thing in the United Kingdom. They have taken a rest here in the United States. They're kind of quiet here. We did have a problem in 2023 where we did see the bond yield go from 4 to 5% in 3 months. But Janet Yellen, the Treasury Secretary Yellen, basically told the bond vigilantes on November 1st, okay, I get it. I'm going to slow down. I'm not going to increase the amount of bonds that I'm going to issue. I need more money, but I'm going to do it with Treasury bills. And that calmed the market down. Inflation came down. And look, the U.S. is still a safe haven economy. That's why I'm not bearish on the dollar. And that's why I think money is still coming here. There is, in fact, monthly data the Treasury posts on its website that show that over the past 12 months, something like $1.5 trillion came into the U.S. Equity and fixed income markets. And equities was like a record $700 billion. So money is still coming in here. And I think a lot of the weakness in the DXY index is because it's 57% the euro. And that really doesn't reflect accurately the value of the dollar worldwide. But the bottom line of all this is, if in terms of what could go wrong, I look at the credit markets. I am watching the private credit markets. I am watching the bond market here to see what the reaction is of the bond vigilantes. Look, President Trump has got a problem now. The Republicans may lose the midterms. And if they lose the midterms, the Democrats will impeach him for a third time. So it'll be a mess for a third time. So he's desperate to win the midterms for the Republicans. And he's talking about sending out checks for $2,000 to a lot of Americans as, from the revenues on taxes on tariffs. But then again, in January, the Supreme Court may rule that those tariffs are not constitutional, and the Treasury might have to give them back. So we could have a scare in the bond market that would scare the stock market.
So whether it's the Fed doing it or the bond vigilantes doing it, the idea is the use of interest rate to kind of bring the economy to equilibrium. How do you factor in the fact that, or how does the fact that that the U.S. economy is just this sensitivity of the economy to interest rates is at historic lows today? Something like, I think I saw the other day, 75% of private sector debt is fixed rate currently, whatever the exact number is. So, how does that factor into, in 2026, again, whether it's the Fed or the bond vigilantes, they're all trying to get interest rate to the quote unquote, the right level.
Yeah.
But the economy is not very interest rate sensitive.
I think that's a good point. And I think the economy has demonstrated it's extremely resilient. Consumers actually enjoy high interest rates to a large extent. On balance, obviously, high interest rates for borrowers is not good, but there are a lot of people who have mutual funds and they've enjoyed high interest rates. But bringing interest rates down takes a little bit of money away from them. But I think technology capital spending doesn't seem to be particularly interest rate sensitive. And here we've got some data coming out in the labor market that shows that we have a very odd labor market. We have very severe immigration restrictions. We've got deportation. We've got AI causing companies to freeze their payrolls until they decide how this technology might work for them. And the Fed is looking at those numbers and saying, well, we need to lower interest rates because the unemployment rate just went up to 4.6%. And so that's what they did a couple of weeks ago. The problem is that it's not at all clear that interest rates can fix the problems that the labor market is having right now. Some of it is a skills mismatch. Kids are coming out of college without the skills that are necessary in this kind of economy. And it's confusing because even the kids who studied software programming, coding, they're coming out of school and there's no jobs for them because one of the things that AI does especially well is code. So it's a very strange labor market, and it seems to me that the problems cannot be solved by creating more demand by lowering interest rates. GDP is quite strong in the second and third quarters, and so do we really want GDP to be even stronger? And low. In other words, what I'm saying is lowering interest rates may not fix the structural problems of the labor market, but they could create inflationary pressures either in consumer prices and or in asset prices. It's probably one of the reasons that silver and gold are doing so well is the perception that the Fed's credibility on inflation is being challenged because they are lowering interest rates when inflation hasn't completely gotten down to where they want it to be, which is 2%.
Got it. Your view is that 2026 will be a continuation of the roaring 2020s.
Yeah.
Having said that, if we don't have a recession in 2026, this would be the longest economic expansion by a wide margin in modern U.S. history, especially if we don't count the 2 month,
Correct.
which you describe. Well, you have used the term man-made recession, the 2 month man-made recession in 2020 during the COVID period. So it's been a long stretch. At the same time, though, it's not like the economy hasn't had any recession. We've had, instead of an everything recession, we've had rolling recessions.
Yes.
So question to you is has changed structurally for the U.S. economy that is now sort of enabled this to happen, as opposed to a cycle of expansion, then everything recession, then expansion.
Yeah.
Repeat.
Yeah, I think we covered a lot of that. I think the resilience of the consumer because of the retiring baby boomers, the fact that more than 50% of capital spending is technology. Whether you like deficits or you hate deficits, deficits are stimulative. They do put more outlays by the government than taxes are raised. It does increase the debt, but so far that hasn't come back to bite us. Maybe it will down the road. And I think another thing to consider is that the global economy has been remarkably resilient. We just stress tested the global economy with all of these tariffs imposed by the United States. And what we've seen is not really deglobalization, but maybe a rebalancing of global economic activity. China has been increasing its business elsewhere, recognizing that the United States is not going to be a reliable market. The United States has been looking more towards Latin America as a area to be more integrated with in terms of economic activity. So I think back to the United States, the capital markets, as we discussed, have become more credit crunch resistant. So, for example, when something blows up, when you have a financial crisis in the credit markets now, there are distressed asset funds. Distressed asset funds, the managers of distressed asset funds are very depressed when things are going well. They love it when things are going badly, and they have a tremendous amount of money to buy distressed assets at 25 cents on the dollar. And then they've got another 25 cents to restructure what they bought. And then if all goes well, they sell it for 75 cents or a dollar. And that's a major shock absorber in the financial markets. There were no distressed asset funds in the 1930s in the Great Depression. I would say China's got a problem that they don't have a distressed asset system that allows them to take all of these these depressed properties and liquidate them and restructure them and liq make the market more liquid. They don't have any liquidity in that marketplace, whereas in the U.S. and other parts of the world, there seems to be more liquidity available to deal with crises that happen in the capital markets. So again, it's kind of the key of all those things. I think the most important thing is the credit system. As long as the credit system can tolerate shocks without going into a credit crunch, without having a recession, then the resilience of the economy from other sources should continue to work. And that should, as you said, 2026 should be another year of the roaring 2020s.
So given that these issues, if you will, in the credit, credit markets and a cause for a credit crunch, something that affects the economy broadly, given that that is that there are systems in place now to deal with that, does that mean that an everything recession is a thing of the past? Or what is the
Yeah,
condition? What conditions would we need to have for this economy to
yeah.
face an everything recession?
Well, you mentioned rolling recessions. I actually coined that phrase back in 1985 when the price of oil took a big drop after the 70s. It had soared, then it collapsed by mid 1985, and we had a terrible recession in Oklahoma and in Texas. And I said it's probably going to be a rolling recession. It's just going to depress the energy sector. Meanwhile, lower energy prices are good for the rest of us, and so we shouldn't have a recession. So that worked out well. And then I started talking about a rolling recession again back in 2022, 2023. I said, yeah, there's a recession in housing. There's a recession in office buildings. Remember some of the pessimism about how the commercial real estate market was going to come unglued? Well, that didn't happen at all. All these problems got resolved through restructurings and quick liquidation. Yeah, we could continue to have rolling recessions, I suppose, without an everything recession. I mean, that's the pessimists just don't seem to learn from experience. I mean, we just had four four years of the most widely anticipated recession of all times that didn't happen. And why isn't it? Well, because the economy is resilient. Well, why is the economy resilient? We've been discussing that throughout our discussion. And you should incorporate that into your thinking about the future, that the economy has changed now. They'll say, yeah, well, you're saying this time it's different. And it's, I'm not declaring that this is a radically different economy, but I think it is an evolving economy, just the way the digital revolution has evolved from the IBM mainframes to the AI. AI will evolve probably into quantum computing, and I think maybe one of the biggest risks of all is that all these hyperscalers are spending tens of billions of dollars on infrastructure that might be obsolete in 3 years because we come up with something better, cheaper, faster.
What about you're obviously the concentration of the market is what led you to change some of your calls. But the concentration of the market also means that it doesn't mean that simply the market caps are concentrated. It also means that stock holdings both by individuals and institutions, in large part, is pretty concentrated as well.
Right, right.
A lot of people, a lot of funds, active funds, passive funds, individuals own a lot of the same stock. I saw a statistic the other day. Something like 75% of the trading volume is essentially within the names that are owned across all types of
Yeah.
stock owners. So there's a concentration not only of market cap, but concentration of ownership, therefore exposure. And the prevalence of stock ownership is as high as ever. So could that potentially be a source of a broad-based stress if
Mhm.
that were to
Yeah.
undo
Yeah,
somehow?
I mean, we discussed what could go wrong, and I focus on the credit markets, but you make a very good point. Something could cause the stock market to crash, and that's kind of like what happened in 1999, 2000. It was a tech bubble that burst that caused the recession in 2000. And people know that, and that's the analogy, and that's why people are asking all the time, is the AI bubble going to burst? And I say, well, it's actually losing air right now because people are realizing that this is a very competitive, that the whole IT business is becoming more competitive than ever. And the reason is because the profit margins are so juicy that it's attracting competitors and when you have competition, profit margins get squeezed, and the ultimate winner is the consumer, the buyer of these technologies. But yeah, the answer is if something causes the stock market to take a dive, that could cause a recession through a negative wealth effect. And 1999, 2000 is a useful analogy for that. Um, but that may also be wishful thinking by people who completely miss this bull market and hope that you know wealth will be taken away and that they'll have another opportunity to get in. But no, the diversification idea is uh, passive ETFs don't have the issue of concentration. They don't care about concentration because whatever the market is what it is, and so if 30% of the S&P 500 is in two is in seven stocks, then an ETF that basically mirrors the S&P 500 is going to have 30% in those seven stocks. Whereas managed money, including people managing their own money or having get in a mutual fund or with a advisor, they do still have limits on concentration. A lot of accounts who manage money say either by mandate or by diversification cautiousness, they won't put more than 2 to 3, maybe 4% of their portfolio in one stock. So it makes it hard for them to do as well as a passive. But I'm arguing that that may change now, and that managed money may outperform passive money because the passive money is stuck without concentration. And if I'm right that technology, generally speaking, and specifically Magnificent Seven, face more competition, and that's really it's a simple story. I call it the Game of Thrones scenario where in the past the seven kingdoms were independent, they prospered in their own businesses, and they didn't attack one another. Now they're attacking one another, and AI is the technology that's kind of forced them to do that. So they're all racing to do things that they wouldn't necessarily have done. Does it really make sense to spend all this money on data centers when you don't really know if you're going to need them, or you don't even know what the return is going to be? And if you didn't have competition forcing you to do that, you probably would kind of slow it down. Competition is great. It creates a lot of benefits for the consumers, but it could also make producers do some pretty stupid things.
Thank you. Well, that's all the time we have. Ed, thank you so much.
Sure. Thank you.